Hello, thank you for joining us. For those of you who don't know me, my name is Michael Israel. I'm one of the managing partners at Revolve Wealth. Today, we're joined by Scott Fite, principal and founder of Prime Pension, and John Tevnin, business service manager at Revolve, to discuss Secure 2.0 for business. Scott has over 25 years of experience as a pension consultant, designing, implementing, and administering thousands of corporate retirement plans. Scott is a member of the American Society of Pension Professionals and Actuaries, a certified pension consultant, qualified pension administrator, qualified 401k consultant, qualified 401k administrator. Scott is also enrolled retirement plan agent. As an enrolled retirement plan agent, Scott is allowed to represent companies before the IRS on retirement plan matters. He's also written and published several articles on various retirement plan topics, and he has lectured extensively on 401k, profit share, and pension plans. As a business service manager at Revolve Wealth Partners, John oversees and develops key relationships and helps businesses and business owners and executives identify opportunities to provide benefits to help retain, attract, and reward key employees so they can be set up for growth and potentially take advantage of amazing tax savings. Thank you both for joining us today.
Thanks, Michael. Glad to be here. Scott, thanks for joining.
Sure.
Today we'll focus on some key points we believe will be helpful to understand this very important act. Many components are still being interpreted and clarified, so we do anticipate further updates over time. But let's jump in. John,
Absolutely.
Let's talk about the Secure 2.0 Act and why it's important.
Absolutely. Thanks, Michael. As you mentioned, Secure Act 2.0, it's an acronym, stands for Setting Every Community Up for Retirement Enhancement. It's legislation that was signed into law December 29th of 2022. This legislation expands upon the Secure Act from 2019 and features several changes to employee and employer retirement benefits. Although the list of changes and updates is lengthy, there are a few key takeaways we'd like to highlight. Today, we're going to discuss required minimum distribution changes, tax-specific changes, retirement plan changes, and changes to part-time employee benefits.
Thanks, John. These are just some of the very, very important topics we'll be discussing today. Scott, tell us a little bit about the changes we should be expecting over the next couple of years.
Sure. So there's going to be some changes that took place as of January 1st of this year. As John mentioned, these act became into law as of December 29th. So we only had a few days to understand the changes that are being made. On the screen you see today, some of the major or significant changes to the retirement plan landscape are RMDs, some startup credits that small businesses are going to receive, and also some tax credits on company contributions. And then we're going to also talk about another controversial topic called the treatment of employer match and profit sharing as Roth. We will talk about 2024, a couple of changes here. And at the same time, we're going to also talk about some changes in 2025.
Thank you, Scott. Seems like a lot of changes over the next several years. Before we dive in a little deep, John, remind us what RMDs are and how we handled them prior to Secure Act 2.0.
Absolutely. So currently, or pre-Secure Act 2.0, an RMD, it's a distribution you must take annually from your retirement accounts like a 401k, 403b, individual retirement account, etc. Once you reach a certain age. So, right, Secure Act 1, I'll call it, or the one that was 2019, changed that age from 70 to 72. They also talked about if you don't take those distributions, the penalties that you're going to incur. Those penalties are as high as 50% on the amount if you don't take it.
Wow, that's a huge penalty if you miss that RMD. Scott, can you review some of the changes to that penalty and the new ages for RMDs?
Yeah, absolutely. So last year, as John mentioned, anybody that was age 72 or older, and this is really for owners or people that are related to owners or terminated employees, had to take required minimum distributions. Under Secure Act 2.0, they increased the age to 73, and you'll also see a bullet point at the bottom that it's going to be eventually increased to age 75 in 2033. But currently for this year, anybody age 73 or older that has money in a retirement plan, they will have to take required minimum distributions. If you think about it, people are living longer, working longer, and that's really part of the increase in the age. In terms of the penalty, yeah, the penalty is 50% previously, which is significant. Under the Secure Act 2.0, it was reduced to 25%. And in some cases, if it's corrected immediately, it will be reduced to 10%. Still a significant penalty, and we do recommend that individuals with retirement plan money at age 73 or older make sure that they consult with the professionals like the financial advisors or the TPA to understand exactly the amount that has to be taken out of the plan before the end of the year.
Great, thank you. Extending this age, which you take your RMD, can be quite beneficial depending on your planning needs and tax situations. In fact, it might allow you to take advantage of other tax strategies in which we touched base on part 1 of a Secure Act 2.0 web series that we had last week. Scott, another change that might be beneficial is regarding tax credits to employers that might be eligible when starting a new employer-sponsored retirement plan. Can you walk us through that and explain how they differ from credits in previous years?
Yeah, absolutely. So previously, someone was able to get a tax credit up to 50% of their startup costs, up to a maximum of $5,000. Under Secure 2.0, there have been some significant changes by the government to encourage small businesses to set up retirement plans. So if a company has not had a retirement plan in place for the last 3 years, then they can set up a plan and receive up to $5,000 of a tax credit. And this is more of small businesses, businesses that have fewer than 100 employees on the payroll. It is possible that somebody that has 20 or more lower paid employees can get the full $5,000 tax credit. Prior to Secure 2.0, the tax credit was 50% of your startup costs. Now, if you have 50 or fewer employees, it's 100% of your startup costs up to a maximum of $5,000. If you have between 51 and 100 employees, then it's continuing what the previous act had under Secure 1, which basically is 50% of your startup up to still the $5,000.
Sounds like the government is really encouraging these retirement plans as they're really partnering with businesses to encourage them to do this. John, thoughts on why they implemented these changes? Like, why does the government even care about businesses starting retirement plans?
Yeah, I think they included this in the legislation in order to directly combat the retirement savings crisis we're seeing in America. I think we see when you incentivize business owners that employees are going to benefit, right? That's going to get some employees to put additional dollars into a plan if they're offered a retirement plan like a 401k or 403b.
Thank you so much. This is great information. Scott, other than startup credits employers can receive, are there any other tax credits businesses should be aware of?
Yeah, absolutely. So besides the startup, they are giving credits for certain types of employer contributions. And we're not talking about defined benefit plans here, but pretty much if you have a 401k plan or a profit sharing plan, you are able to get up to $1,000 per person that's in the plan. And that can add up to some substantial dollars. And it's really for those people that are considered non-highly compensated employees. That $1,000 is for individuals that are making less than $100,000. So what you'll see on the screen today is that it is possible that every single person that you have in the retirement plan that's non-highly, that's making less than $100,000, you can get up to a full $1,000 of a tax credit. So by doing that, the government is providing more incentives for small businesses to set up retirement plans and put more money away. Those credits are going to be phased out over a 5-year period as disclosed on the bottom bullet point. It goes from 100% of the full $1,000 down to 75%, 50%, 25%, and then being phased out. So this is a significant benefit that the IRS is providing businesses and encouraging them to start up these retirement plans.
That's pretty significant. We're talking about a tax credit, which is dollar for dollar that the government is actually giving you, not even a tax deduction. Pretty big
That is
investment
correct.
from them. Do you
Absolutely.
think this tax treatment will push more business to open these employer-sponsored plans?
Yeah, absolutely. Already we're seeing small businesses being encouraged by their accountants and their financial advisors to set up these retirement plans. And you'll see on the screen now that there's a couple of examples of the tax credits that they can receive. So the first circumstance that we have here is we have a small business. They currently have 10 of their 12 employees participating in a plan. And of those 10 employees, 8 of them are making under $100,000. And this company is given a match to each person of $2,000. So what we're doing here in terms of the tax credit is for the 8 employees that are under $100,000 in wages, they are each getting a $1,000 tax credit that the business owner gets to apply to the tax return. Therefore, they get a total of $8,000. This still works even for large clients, large being between 50 and 100. Over 100, they're not getting the tax credit, but between 50 and 100, they are still getting a significant tax credit. The facts two below show basically another match of $2,000 for 61 people of their 80 employees. So 61 people are participating in the plan. Of those 61 people, almost everybody is under 100,000 except for maybe one of them. So what we're doing is we're showing the calculation below of how the IRS wants us to phase in the tax credit for these contributions. And at the end of the day, this business owner is able to get a tax credit of $48,000. Substantial.
I mean, these are really substantial dollars. That's encouraging to start a plan for sure. There's even more changes. The Roth component, which was implemented in 401ks a long time ago, but was never considered as part of a match or a profit share. I believe there's some changes to that in this new plan as well. Can you dig a little deeper on those changes?
Yeah, prior to Secure 2.0, when a company deposited employer match or profit sharing contributions, those always had to be made on a pre-tax basis. Now under Secure 2.0, and this is effective today, an employee is allowed to designate as part of their match or profit sharing contribution as Roth money. It's going to be a little bit of an administrative nightmare because if a business owner wants to take advantage of this, and it's discretionary provision, then they really have to go to the employees and ask them, do you want your match designated as Roth before it goes into the plan? If they decide and elect yes, that they want the money designated as Roth, then that money needs to be taxed. So still waiting for some more guidance on how that's going to be taxed. Is that going to be something that's going to be going through the payroll provision, or does a 1099 need to be generated by the third-party administrator or the investment record-keeping company? Some plans already allow for in-plan conversions. Those are already permitted. But this additional feature is going to allow the money to go in immediately as Roth between the match and the profit sharing contributions. One thing that I do want to mention is that in order for this to be effective and the participant to elect it to be as Roth, they do have to be 100% vested in either that match or that profit sharing contribution.
So many components to this, it's hard to keep up. I assume there's different types of record keepers, different types of goals for business owners, and a lot of complexity here. Do you see any issues with record keepers and 401k providers tracking this? And with this work and complication, why would a business owner want to utilize the Roth contribution feature?
I do think record keepers will have the capabilities probably sometime mid 2023 to the end of 2023. They will have this feature in. They knew that this was coming down the pipeline, but now Secure 2.0 solidifies it. Some businesses, they are big fans of the Roth, and they are going to encourage their employees to take advantage of this. I do think it is going to be some administrative work for the business owners. So there will be some that will not take advantage of it. Only time will tell.
Well, closing out some key topics for 2023. John, what are some final thoughts, takeaways we should take in consideration?
Absolutely. So like Scott said, these all of these changes we've talked about so far are immediately effective, right? January 1st of 2023, they go into effect. We'd urge everybody listening to the webinar or listening to a replay today to get in touch with us, ask how it might impact you, right? We have Scott as a resource, Michael, myself, the whole team. We'd really urge folks to get in touch with us. Two other quick changes that are worth noting are the change to the 10% tax penalty we're seeing if somebody needs to take a distribution due to terminal illness. That's going away. And also some rules if you're a sole proprietor and wanting to retroactively implement a 401k plan. So some changes there, but yes, I'd urge folks to try to understand these rules on your own and get in touch with us if you need some further clarification.
Let's move on to 2024. Scott, catch-up contributions have made some changes in this rules as well. Can you go into some of that?
Yeah, absolutely. So prior to Secure 2.0, or even currently today, when someone is age 50 or older, they can put a catch-up contribution into the 401k plan. The current catch-up, as indicated, is $7,500. They can decide, do they want to do it as pre-tax? Do they want to do it as Roth? Do they want to do it as a combination? Starting next year, 2024, if someone made more than $145,000 in the prior year, which is this year, 2023, then they have no choice but to have their catch-up contribution designated as Roth. So this is an unusual provision. For me personally, I was surprised that this was added to the Secure 2.0, because if you think about it, there is going to be some administrative work that has to be done by the payroll companies and the HR department. If you have an individual that is age 50 or older and they are electing a catch-up contribution in 2024, that individual, let's say the HR department, they have to go back. They have to look at the records and see how much that individual made in the prior year, in this case, 2023, to determine if that person made more than $145,000. If they did, then they have to designate that money as Roth. And some plans today that have 401k plans, believe it or not, don't even have a Roth provision. So now it is time to discuss with your financial advisor, with the third-party administrator, to see what changes need to be made in 2024. If you don't have a Roth provision, then you are going to need to add one. Otherwise, it may prevent certain individuals to even putting catch-up contributions into the plan. Keep in mind that this applies to 401k plans. It does not apply to SAR/CEPs or simple plans.
So Scott, year by year, income can fluctuate, especially for folks who are heavily bonused, folks who are sales and commission. How do you handle that fluctuation in terms of these catch-up contributions?
It's a good question. It's something that who's ever handling payroll is going to really have to have a conversation with the third-party administrator. This has to be done early in the year, even before the year starts. So what we're going to be doing is having conversations with our clients in December of this year, 2023, to basically go through these regulations and go through which individuals made over that dollar threshold and make sure that they somehow put some kind of tickler or an alert that those contributions are going to have to be designated as Roth. We're really hoping that the payroll companies will have something in place that will already identify this. I'm assuming that's where the payroll companies will head, and that will make the payroll companies stand out from some other payroll companies that may not provide that service.
Scott, there's not all retirement plan providers offer Roths inside their plans. I assume they would have to update that.
Correct.
In addition to that, what about the self-employed individuals? How do they navigate through this?
Yeah, for the self-employed individuals, they are also going to have to make sure that they're going to have to go back to their earned income that appears on their Schedule C or K1 for the prior year to determine if it's over that dollar threshold, if it's going to have to be designated as Roth. A lot of times, the self-employed individuals make their Roth contributions after the year is over, and that's permitted. As long as they have some designation, something in writing, what their intentions are, they can actually put in their 401k contributions up to the filing date of their tax return. And at that time, they're going to have to make the designation if they're going to have it as pre-tax or Roth. And if it's a catch-up contribution that they want to put in, they really have to go with their accountant and look at the prior year to determine if it has to be designated as Roth money.
Well, we know about the RMD impact for 2023, and sounds like there's some further nuances from Roth 401k and 403b accounts. Can you talk a little bit about that?
Yes. So as you may know, if you have money in a Roth IRA and you're required to take an RMD, you not have to take anything out of the Roth IRA. But if you had money previously in a 401k plan or a 403b plan and you had to take an RMD, as third-party administrators, we would look at the account balances that are in the Roth account. And those account balances count towards the amount that someone has to take as a minimum distribution. Now, under Secure 2.0, they made the Roth money have similar characteristics as the Roth IRA, meaning that when we calculate the RMD, we can completely ignore how much money is in the Roth account when we calculate the RMD. So it's possible that somebody, for example, is 74 years old next year and all of their 401k money is in the Roth account. They're able to exclude that when we do the calculations of the RMD. So it should reduce the amount that they have to take out of the retirement plan.
So that's exciting news. I mean, that's great to be able to extend this tax-free growth within a 401k. I mean, that's absolutely amazing. The next one was kind of interesting, I think, around student loans. So tell us a little bit about that big change.
If you think about it, there's a lot of people in this country that have substantial student loans. And because of the loan payments that they have to make, unfortunately, they have not been able to save for retirement. They haven't been able to contribute to the 401k. Therefore, with companies that have a 401k plan and have been making company matches, those employees have been missing out on company contributions. So under Secure 2.0, there is a provision in here, and keep in mind that this is completely an optional provision. But business owners are allowed to take into consideration the payments made for student loans when they calculate the company match. So for example, if somebody has made a $5,000 payment in student loans, but no 401k contributions, the business owner can determine and calculate the match contribution using that $5,000. The employee is going to have to provide some type of proof that they made a student loan payment, in this case, $5,000, but that should be pretty easy to provide some documentation. But again, it's up to the business owner if they want to go down this path. From talking to a lot of business owners, some of them, a lot of them are not going to take advantage of this. This is a lot of work. They may have a lot of employees that do have student loans, and to gather all the information that they need from the employees in an efficient and effective manner in order to be able to get it to the third-party administrator to calculate the match, it's going to be a lot of work. But don't get me wrong. I have talked to some small business owners, and they do want to reward and take care of their employees, and they are going to take advantage of these provisions next year.
It sounds quite attractive. I mean, I hear all the time how inundated folks are with their student loans and how to pay them back and how to juggle paying back the loans versus saving for retirement. It sounds like it could be a great hook to attract key employees and retain them as well and show them that they care. How does this work with testing?
So the good thing, at least, is that those contributions or those deposits made into the account for the match, those are going to be included in testing. So if a company puts a match in for somebody, it'll be included. But if someone has student loan payments, that's not included in our testing. So we are going to be able to ignore those student loan payments.
Let's move on a little bit. Some other provisions. John, maybe you could provide some light on this around the force out amounts changes for participants who are no longer employed by the employer of the 401k.
Yeah, absolutely. So folks on the webinar that are listening in that are maybe administrating a 401k or 403b plan are probably familiar with the old rule, right? If you have a $5,000 account or smaller, you're able to force folks out of the plan, right? That's been in place to help, clean up some plans maybe folks haven't been at the company for a few years, you're able to force them out into an IRA. There's a couple different options there. We're seeing that change in 2024 to go up $2,000 to a $7,000 cash out limit. So small change there.
Great. Thank you, John. Then you have some other withdrawals features. Emergencies come up quite frequently, and the ability for folks to be able to take care of those emergencies are pretty important. Scott, can you talk about that withdrawal change?
Yes, this is an optional provision as well. And what small businesses are allowed to provide for their employees is the ability for the staff to take money out if they have some type of emergency. And the limit is going to be up to $1,000. And if they do take the money out, the advantage of it is not subject to the 10% premature distribution penalty. So if someone's under the age of 59 and a half and they take money out of a retirement plan personally, they do have to pay a penalty. Here, under this, they can take $1,000 out penalty free. They're still going to have to pay the taxes on it. If they do take $1,000 out, and they can only take up to $1,000, then for the next 3 years after that, they cannot take out any more payments for withdrawals for emergency reasons. But what's interesting is there is a provision that's put into Secura 2.0 where that employee can deposit the money back in at a later point in time up to 3 years. If they can, then they can always amend their tax return. But if once they make the deposit back into the plan, then they can go ahead and take out another subsequent $1,000 emergency withdrawal from the plan, even if it's prior to those 3 years. At this point, it'll be interesting to see if small businesses take advantage of this. I do think that a lot of companies will, because they want to make sure that they take care of their employees.
It sounds like a great benefit. Emergencies come up all the time, and folks to balance the surprises that come up in life with also saving for the future. Sounds like it will encourage folks to now participate and save for retirement, knowing that that lever is there. Scott, any notable changes coming our way for 2024?
Well, one thing that I do want to mention, which we get a lot of questions on, is we have clients that come to us and they currently have simple plans and they want to stop their simple plan and they want to switch over to maybe a 401k plan, profit sharing plan, or a defined benefit plan. Unfortunately, the way the regulations are set up is that a simple plan is what's called an exclusive plan for that calendar year. Meaning if you've made contributions to the simple plan at any point, for example, in 2023, then you can't stop the simple plan and convert over to a different plan. You're stuck with it for the full calendar year. But starting in 2024, this is a welcome change that small businesses that have simple plans are able to stop the simple mid-year and switch over to a 401k. The caveat is that they have to have some type of safe harbor feature in place, like the safe harbor 3% of pay for all the employees. So we are going to see a lot of businesses make that change starting next year.
That's great. Let's now change gears towards 2025, about how catch-up contributions are handled for people over 50.
Yeah, this is an interesting change. This is a change that, first of all, only impacts people that are ages 60, 61, 62, and 63. So somebody that in 2025 that's older than 63 is not going to be able to take advantage of this catch-up. There may be some changes in the next couple of years where they'll make it everybody who's catch-up eligible. This will impact them. But basically what the rule is under Secure 2.0 is starting in 2025, anybody that is aged between 60 and 63 is going to be able to make a catch-up contribution, which is going to be the greater of $10,000 or 50% more than what the catch-up limit is in place at that time. So if the catch-up limit in place in 2025 is, let's say it's $10,000, they'll be able to put away $15,000 at that time.
Well, now we have the part-time employees. I mean,
yeah,
many of them were not able to access 401k plans, couldn't save for retirement. And if you can, review some of those changes coming in 2025 that might impact these part-time employees and maybe allow them now to save for retirement.
So currently, small businesses or even large plans are allowed to exclude part-time employees from the retirement. Many businesses only want to take care of their full-time employees. Full-time employee is somebody is defined that works at least 1,000 hours in a year. So there are some people that are with companies but are constantly working less than 1,000 hours. What Secure 2.0 allows, and actually there were some provisions in Secure 1, but this shortens the time for part-time employees, where if they work at least 2 consecutive years of at least 500 hours, then they're going to be able to enter the retirement plan. So again, 2 consecutive years of at least 500 hours, they are able to enter the retirement plan. What they're going to be allowed to do is they're going to be able to contribute 401k money out of their own paycheck. But under this long-term part-time employee change, the business owners are not required to provide any type of company contributions, not subject to the top-heavy rules. So for example, if a company is given a match contribution and one of these long-term part-time employees contributes to the 401k because they met the consecutive 2 years of 500 hours, the business owner does not have to give them a match contribution. They can if they want, but it's not required.
So to confirm, will these part-time employees be included in testing contribution calculations? Doesn't sound like they are.
They're not. Yeah, you're right, Michael. They're going to be completely excluded from all testing, from all company contributions. Also with this, any service, which you'll see in the last circle, any service that they have earned prior to January 1st of this year, 2023, is excluded. So the earliest and under this provision that someone can come into the plan is 2025, because they'll have 2023, 2024 as 2 consecutive years with at least 500 hours. The following year, they'll be able to enter and contribute to the 401k.
Several years ago, automatic enrollment was enabled in a lot of 401k plans, and the new act expands on this. Are existing plans expected to adopt this new rule, or does this only affect new plans, and how will it be enforced? Expand a little bit on that.
Yeah, the way it was put into the regulations is a little interesting. Any plan that was set up prior to 2023 is not going to be required, at least at this point in time, to have automatic enrollment. But plans put in place in starting now in 2023 or 24, at some point in 2025, they will have to retroactively and add automatic enrollment to their plan. They don't have to retroactively and auto enroll their employees, but they do have to look back and see if a plan was started in 23 or 24. In 2025, they have to add an automatic enrollment feature, which means that if an employee is eligible to participate in the plan and they don't do anything, they don't fill out any forms, they don't provide any elections that say that they want to contribute 0 or waive out of it, then the business owner is going to have to withhold at a minimum 3% of the pay. It could be more than 3% that they can put that provision into the plan. So plans will have to be updated in 2025 to have this automatic enrollment and feature. Besides the automatic enrollment, there is a feature that they're allowed to put into the plan, which is auto increase, meaning each year that 3% can go up by 1%, up to, it normally will stop somewhere around, as you see here, 10%, can go as high as 15%. There is some exceptions to this auto enrollment. The exception is if it's a small business and you have 10 or fewer employees, then you're not going to have to add the auto enrollment, or if it's a new business that's been in business for less than 3 years. But what's interesting is, so let's say someone sets up a plan in 2025, they are not required to have auto enrollment if the company just started, but they do have to keep in mind that a few years later, after they've been there for 3 years in existence and they have more than 10 employees, they're going to then have to add that auto enrollment feature. So a lot of third-party administrators like myself, we're going to try to encourage these clients, these companies, to starting in 2025, just automatically add the auto enrollment.
Thank you, Scott. It's a huge act, making lots and lots of changes. We only hit the tip of the iceberg with some of our key takeaways and key points that we discussed. There's more, and I'm sure there'll be lots of changes and interpretations along the way. John, can you share some final thoughts on how we can help get folks through this?
Of course. Yeah. So, I mean, we covered a lot today, right? A lot of immediate changes, some stuff coming 24 and 25. So again, I'd urge everybody listening in or listening to the replay to get in touch with us, right? Connect with myself, with Scott at Prime Pensions to help understand these changes and how they might impact you as a business owner or an executive at a business or somebody that works closely with businesses. At Revolve, we can assist in reviewing retirement and benefit plans to understand if they're up to date with current rules and regulations, right? With the help of Scott and his team. Making sure they're competitive in the marketplace is key, and also making sure the plan design is in line with the goals of the business, right? So understanding the automatic enrollment features, things like that, size of the business is going to impact that, goals of the business and how much, the owners want to save into a plan. Our goal is really to help you as that business owner or person that's working with businesses to attract and retain key employees, right? Having some great talent, and then also maximizing the benefit of the plan for those top executives or business owners.
Scott, this has been great. Thank you. So much information, so much value information. Thank you both for your time today. As I mentioned, these were some of the notable changes that we believe might have some great impact on many, many, many businesses and the business owners and their employees. Other changes will also provide value. We will continue to evaluate these provisions as they're implemented and finalized. Thank you all for tuning in. Today's webinar is the second in two-part series. To watch part one, we will send out, you can see on our social media platforms, to watch Megan and Rob talk about how these rules pertain to the individuals. But we will send out a replay of both webinars to everyone on this call. Once again, John, Scott, thank you so much for joining. Until next time, thank you all.
Thanks, everybody.